Hi everybody, this is Alan Ellman, the Blue Collar Investor. The title of today's video is What is Covered Call Writing? Many of you may have heard about this strategy, but don't have a clear understanding as to how this works. So let's spend a couple of minutes reviewing the strategy called covered call writing. The definition of covered call writing is actually combining two strategies, stock ownership and option selling. We are selling options while owning the underlying securities. Let's look at the three words, covered, call, and writing. Covered means we own the stock or exchange traded fund before selling the option. That puts us in a covered rather than a naked position regarding the option. Call. We are selling the right for the option buyer to buy our shares. So that's what a call option is, the right but not the obligation to buy shares. And we are selling that right to the option holder. And finally, writing, which means we are selling, not buying the option. So we're buying the stock, and then we're selling the right to the option buyer to purchase our shares from us, but it's not an obligation, it's just the right to purchase. Let's look at the components of the covered call trade. We first own the stock or exchange traded fund. An ETF is a mutual fund that trades like a stock, and many of them have options. We then sell the option. We sell the call option. We sell the option buyer the right, but not the obligation, to buy our shares from us. And this can be accomplished in either two stages or one stage. Executing a covered call right in two stages is called legging in. That's where we buy the stock first, and then in a separate trade we sell the option. The other way of executing a covered call right is in one stage, and that involves using a buy-right combination form. And that's a little bit more complicated. So in today's video, we're going to concentrate on the two-stage or legging in execution of a covered call trade. Stage one involves buying the security. Once again, we want to make sure that we buy one of the greatest performing securities. So we use a fundamental analysis, which is earnings and revenues. Then we use a technical analysis. We evaluate the price chart to make sure that there's buying momentum for that particular security. And of course we have to make sure that the stocks have options. At the time this video was being produced, about between 2,500 and 3,000 securities had options associated with them. A little less than half the available securities have options. Stage two involves selling the option. Now, when we sell an option, we, the covered call writer, determines the sale price of the stock. That's also called the strike price. We, the covered call writer, determine the sales date, which is also called the expiration date. And that would be on the third Friday of each month. The market will determine the amount of cash profit that's generated from the sale of that option, and that's called the option premium. Let's do a preview example, and then we'll look at a real-life chart. Let's purchase 100 shares of company XYZ at $48 per share. So our cost basis is $4,800. We then sell the option. We're selling the option buyer the right, but not the obligation, to buy these shares from us, and in this hypothetical we'll say for $50 per share. That's the sale price, also called the strike price. And the option buyer can exercise this option at any time over the next 1 month. And that's called the expiration date. So it will be the third Friday of the following month. In return, we receive a cash premium. In this hypothetical, let's say the premium is $1.50 per share, which is a fair amount for a trade like this. and that's $150 for the 100 shares. Now our initial return, therefore, is 3.1% for the 1 month, 37% annualized. We get that by dividing 150 by 4,800. That comes to 3.1%. That's our initial option return. But the trade still has a month to go, so let's look at the two possible outcomes. In the first outcome, at the end of the month, the stock price is less than the $50 agreed upon sales price. Our shares are not purchased from us. Why would the option buyer buy our shares for $50 when they're trading for less than $50 at the time the options expire? So we keep our 3.1% 1 month profit, and now we're free to sell another option the next month. The second possible outcome is that at the end of the month, the stock price is above the $50 per share, and our shares are purchased from us. Now, there are ways of avoiding this, but that's not within the scope of this particular video. But let's say the option is exercised and our shares are sold for the agreed upon $50 sales price. We now make an additional $200 on the sale of the stock because we bought the stock at 48, we sold it at 50, and it was 100 shares. We still keep the initial option premium of 150, so our total 1 month profit is 350. 150 from the sale of the option, 200 from the sale of the stock. That represents a 7.3% 1 month return, or 87% annualized on our $4,800 cost basis. Now let's look at a real-life option chain. Some of you may be familiar with options chains, others may not have seen one before, but let me point out the highlights of the options chain and show you how we would calculate our returns in this particular example. On the top middle, you see the company is TUP, Tupperware. Many of you are familiar with that company. And to the right, in the red circle on the top, you see that on January 15th, the price of the stock was $44.14. Now, the options chain below, you'll see the green arrow on the left pointing down to the $45 its strike price. That's one of the sales prices that we can decide to sell our stock for. And when we buy a stock at $44.14, we'll usually look to the closest strike price. Although we have several choices here, let's concentrate on the most likely one, the $45 call. Now, further to the middle of the page, the second green arrow pointing up, you see $1.85 under the bid column. The bid is usually the price that we could sell our options for. So we sell at the bid. If we were buying an option, we buy at the ask, $2.05, but we're selling at the bid. And in a future video, I'll show you how you can usually do even better than that. But let's look at worst case scenario where we would generate $1.85 per share or $185 per contract from the sale of that one option. And that represents better than a 4% 1 month return using $44.14 as our cost basis. So learning how to read an options chain is critical if you're going to use the strategy of covered call writing. Now, everything looks rosy so far. However, there is risk in this strategy, and the risk is in the stock price declining. So it's critical that we manage our positions. And that's done in several ways. We already talked about the stock selection process. We want to make sure that we are using stocks that are fundamentally sound and stocks whose chart patterns are technically sound. We also interject some common sense principles like proper diversification. For example, if you're going to have 5 stocks in your portfolio, we don't want to use all computer hardware stocks, because if that industry should plunge, then our entire portfolio will decline. So we would want to make sure that we have 5 different stocks in 5 different industries, so that if one goes down, we have the other 4 to pick up that one particular stock in our portfolio. And there are several other common sense principles that, again, are beyond the scope of this particular video. And finally, the use of exit strategies is critical. What if your stock price dramatically increases or dramatically decreases during that 1 month time frame? There are certain strategies that you can undertake to either mitigate losses or increase gains. So I've written an entire book on this one subject of exit strategies for covered call writing, and no matter what strategy you use for covered call writing, it's critical that you have a series of exit strategies on call and ready to be executed if needed. So let's summarize the subject of this video. What is covered call writing? We buy a great performing stock, and great performing both fundamentally and technically. We sell an option generating a cash premium, and then we manage our position using exit strategies. Sounds simple. Does take a couple of months to really master this strategy for those of you just starting out, but it's time well spent if you feel that this is a strategy right for you. As always, feel free to contact me directly at alan@thebluecollarinvestor.com and visit my website, thebluecollarinvestor.com, which has a huge amount of free information on this subject and subjects peripherally related to covered call writing. Thanks for listening. Take care, everybody.